Hi and welcome. This is my name is Jonas Thulin, and I'm head of asset management here at Erik Penser Bank, and I will try to give you an outlook for 2023. Now, first of all, some 90% of our asset management is above their benchmarks, which we're quite. I mean, this is sort of a naive comparison a year when we're pretty much all of us are down, but still it all becomes relative basis, and this is where we are beating, and we're comparing only those products and portfolios that have over $50 million in them. And the threshold for us to be green is 80%, and we're currently at 90%. So basically, when we look at 2023 and how we position ourselves, this is sort of the very holistic view. We believe that we're going to be see a more normal market environment with growing equity markets and lower yields. We believe bifurcation will continue, i.e., we will have recession, soft landings, and growth at the same time, mutually existing around the globe. We also believe that we will have European Eurozone recession to 90% probability, whilst the probability for US recession is only 25%. And we also have to remember that a lot of this has already been priced. Hence, risk reward for us is to follow data, not the consensus. On the right hand, I just threw in a graph showing the recession risks for the US through various measurements. And it's there, it's 25%, but it's not really much more than that. And as such, it cannot be our main investment case going into 2023. When we do our GDP forecast, you have all the. Now I do apologize because now I realized we actually written this in Swedish, but at least you can read out USA in terms of GDP forecast, the Eurozone, Sweden, etc. You can see the negative numbers in Sweden, while it's positive in the US and positive in the world. Those forecasts leads to an asset allocation, and you can see that we are overweight equities given our benchmark. And I would derive why that's so, and also these forecasts leads to these regional weights in terms of equities, where you can see that we actually are quite underweight US, which is a completely big shift from where we were a couple of months ago. So that's something new for us, and we pretty much put those money in the Nordics, Europe, and Germany. Obviously, Germany is a part of Europe, but that Germany we separate it out here because it's a solid big strategy for us for the time being. Now that said, and here you pretty much go. There are too many words on this graph, and I would tend to agree. But this is the holistic picture. This is actually under the hood. What are we looking at in this presentation? All these factors are derived in this presentation, albeit on a tip of an iceberg level. And I will show you a few of those as we should quickly run through this in order to drive our quite optimistic view for 2023. Now, first of all, we believe that uncertainties both on a macro and financial level are elevated compared to the historical norms. We believe that the macro uncertainty and financial uncertainties will come down. We believe that one of the reasons for this is that media, which has been spending years being way too stressed of the outcome in financial markets, has to sort of calm down a bit and move down into the historical norms of being equally as stressed on an average given markets. And if not, that doesn't really matter. What matters most is that we actually see falling trends in uncertainties. And this obviously coincides with the year that we're entering. We're entering the third year of the presidential cycle, which is the strongest year from the equity market. We can see the political risk in the US inverted is falling and it will continue to fall. This is the most likely scenario for the future of political risk in the US. And pretty much we're having two lows in that sense. We had the war and we had the midterms, and those are now behind us as we move into the third year of the presidential cycle. And also keep in mind that these enormous uncertainties we have had to handle, the pandemic, the trade war, etc., 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 they're pretty much all gone now. Not gone from a human perspective, but gone from an uncertainty, i.e., market perspective. They can come back, but we believe that we can always be nervous and afraid. But that's really very difficult to manage money with that kind of mentality. So we have to look at the data and see that yes, we're finally moving into a normal range and long-term mean, and that's where we think we're going to stick. And that will be the first longer periods we've had since 2016, 2017 almost, where we saw more of a structural shift in uncertainties going on the low side. Importantly, when we move into equity side and CPI, we believe that we are moving from a high inflation, low growth environment to a normal inflation and low growth. And the shift there for the equity market could not be bigger. This is based on data since the 1970s, actually 1970. That means that rather than living in an environment where we know on average you're going to lose 10% on your own equity portfolio, you're gonna know you could at least think you know that you're gonna gain 15% on your equity portfolio. The shift here from going from high inflation, low growth to normal inflation, low growth is tremendous. And here you have the full distribution and the 20th to 80th percentile as well. That is actually one of the biggest shifts you can do in terms of changing paradigms, and that's something that we're quite excited about going into 2023. And we will not miss this opportunity going into 2023 because that would be very costly. I.e., if you missed Q4 rebound already, or if you weren't able to make a trough in June, I think you are already struggling with your indices and comparisons and your competitors. Um, I will come back to equities more. Obviously, the energy crisis will still be with us. We keep track on that, but there's nothing we really take any positions on for the time being. Peak inflation, as I said before, it's set in stone. All these variables that we've been talking about the last couple of weeks, they are still valid. They're still talking a very stubborn language of falling inflation. You can even do some math and just looking at what month-on-month scenarios will lead to a about 2.5% inflation number by summer, and you have to make some quite aggressive month-on-month increases. The most likely is that the year-on-year will actually come in lower, and this is not really earth-shattering or anything extraordinary aggressive in any sense. It just follows pretty much what the U.S. consumer is telling us where inflation will be. So the Fed has certainly been able to put a lid on consumer expectations, etc., etc. Now, supply bottlenecks clearly doing their part, falling to bits, and quite aggressively will turn CPI a lot lower fairly quickly. Supply and demand doing their thing. We had a huge demand spike in the US and not so much any longer, but still you're able to be on the sort of historical patterns between supply and demand, which is quite strong for the economy. And we also know that China, etc., and Brazil, for that matter, is already experiencing negative PPI pressure. If you look at the PPI CPI gap, you have a pretty good indicator for the US CPI, and you can clearly see it's rolling over and going lower. The same goes for ISM prices paid and commodities, etc. Also, if you look at St. Louis price pressure coming in lower and lower and lower. So for us, this is pretty much set in stone. We have to estimate that CPI will roll in lower, and that will have huge implications for the equity market. You cannot sort of hide away from that fact, I would argue. That also means that you come back to this pivot, because if that's correct, not only did the Fed already pivot back in October in the sense of, that was when we had maximum price pressure in terms of hikes, but they will actually start to deliver on the cuts going to 2023. We see a 25 basis point cut in end of 2023. This is the Fed curve, what it looked like before the first hike in March this year. And you can see already then we knew we were going to end up with a cut, because we already then knew, we in the market, that the CPI will roll over quite aggressively. Then you were quite hawkish back in when you actually hiked the first time, that well, they can actually be on a sticky rate pattern. And then the market goes, nah, you might go longer, so we become more pointy, but that only means you have to reverse rates more quickly. And there are more reasons for that. But obviously, the CPI being one thing. So if you look at 2023 in detail, this is sort of the blue boomerang that I usually talk about. There you can see we're going to hike up to 5% as a top range, but not much more than 5%. There's some whiskers out here that we would not go and trade on. And then you can see sort of the blue wave turning back, and then all of a sudden you have priced in a almost 50 basis points cuts by December, and we believe in 25. But it's quite interesting that we can really see this kind of blue wave now opening up in the market. Now, the 25 basis points will not do, though. If you look at what the market is priced in, if you look what's going to happen in a year's time and a year ahead, so i.e. the 12-24-month gap, if you look at those future contracts, you can actually see that you're going to have over 5 cuts in terms of rates. That means you're going to have between 1.25% and 1.5% rate cuts from the Fed, and that's already been priced in the market. That obviously coincides with the fact that if the soft landing was to crash and fail, that's where we're going to see that sort of the brunt of the negative GDP pressure, if it was to materialize at all, I should add. But it's quite interesting that so much been priced in terms of cuts. Now QT continues and being as unexciting as paint drying on the wall. Nothing really happening now in terms of risk. The dovish pivot that happened in the Fed language that we can sort of push out and look at versus the equity market or the rate market, we think that will be maintained, i.e. there's no idea of going tilt now is dovishly and then just to tilt it back, especially when CPI is rolling over as quickly as it is. So we think that's going to stick going into this week's meeting. Obviously, we all know that the underlying inflation peaked almost a year ago and has been stubbornly just going lower, lower, lower. So finally, we jumped on board and we bought U.S. Treasuries a couple of weeks ago. We were around above 4% then in yield terms, so we're quite happy to be in the money on that one. But for us, this is more of a tactical trade just to get some good addition on in the portfolio. But we believe also that 2023 will see lower rates following the Fed. Now we can skip the impact of the pivot, but I would like to point out that 2023 is really the year where global peak hawkishness becomes mainstream. Global peak hawkishness has already happened, but they will become more mainstream as we go into 2023. It has already happened. As you can see, the green bars peaking and then coming lower again. They will not turn around, i.e. the world will not turn more hawkish again. So this is quite interesting, and I think there will be some more talk about that as we move into 2023. But do remember that peak hawkishness has already happened, and that's obviously the reason why this fourth quarter in the U.S. equity market has such a booming development. Financial conditions stable but lofty, and we think they will turn lower. They actually are turning lower as we're speaking, going into 2023. But really, the trick for 2023 is how it affects the economy. We look at NACM, we look at SLO, we look at financial matrices to highlight and pinpoint and track the effect of the sort of the past squeeze of financial conditions. We can't really see anything else for the time being than a soft landing. In terms of market vol, if you look at rate vol and equity vol, we think those will both come down to the historical averages. The reason is that we have this blue indicator that when it shoots up, we always see the verse, sort of the antithesis of that is falling vol, and they see that going into 2023 that market vols will fall, and that obviously correlates with market uncertainties. We believe that strategic asset allocation will be quite stable in 2023, i.e. the blue bars that are sort of, if they really break on the lower side, we sort of have to act in the portfolios, but you really can't see that kind of tremendously push in these indicators any longer. That means the economy or the markets becomes more and more resilient to volatility and uncertainty that might pop up, and there's obviously something positive. In fact, since the 1980s, this has actually been an exponential trend that becomes more and more resilient in terms of strategic asset allocation. We also know that we have very few positive equity days in 2022 and think that will mean revert back to becomes a bit more positive in 2023. Chinese equities will compete again in 2023. We have a small position still in China. Yes, it will finally back, beating global benchmarks on that position. We're quite happy to keep it, hoping that this liquidity injection will give more boost on the upside for Chinese equities. Very importantly, though, if you look at market risk indicators, if you look at, for example, making an indicator on rate spread, CDSs, FX vol, fixed income vol, emerging market, we're actually now in the most positive environment we have been since almost over a year. So we're more constructive now for the equity market than we have been in any time during 2022. And I think that's quite important as we roll into the end of 2022 with a very strong fourth quarter and also a quite interesting outlook for 2023. Now, we also believe that we're going to be in a positive fear and greed environment in 2023. The reason for that is not really hocus pocus. This is a mean reverting indicator. So it's quite interesting that after years of this tremendous move on the downside, statistically, you're almost bound to have a rebound. Now, what's behind all this optimism is obviously also some real data in terms of real flows. We can actually see now we have some positive equity flows going to the equity market. We know that we have quite a good cash allocations of up to 25%. We know that historically that's a quite lot of cash. And we believe that this coincides with the drawdown in the equity market. And as the drawdown ends and turns around, the cash will come back to the equity market. And obviously, if we are able to maintain and also make money, or at least from the trough that we've had since June, to see more money coming in from the sidelines is, of course, the best thing that could ever happen, because then, we just get more wind in the sails. Now, don't forget the world of theorems. They are also supporting equities. Tobin's Q, for example, is clearly indicating that the whole downturn in the equity market was unwarranted. Total factor productivity, the whole downturn was unwarranted. I.e., we have to remember that this slowdown in the equity market was not due to a profitability side or anything like that, like a normal business cycle. This is a war that we're dealing with a cost pressure, with energy shock, etc., that led to demand factors on the CPI, especially in the US, much less so in Sweden and Europe. But at the end of the day, we have a beating on sort of on negative on earnings revisions, but from an EPS perspective, the impact has not been as big as that would have been if this was a normal profitability cycle in that sense. So I think that's also worth keeping in mind. If you look at the P number, and given where rates are in the business cycle, you can actually see a good upside potential as well. If you look at the Hoyuba liquidity ratio, you can see that the ratio is climbing, i.e., people are more willing to buy the move up in the equity market than they are willing to sell on the move down in the market, and that's a huge thing behind the equity market as well. Now, if you look at behavioral finance, we can actually quantify that, and we can see that how the equity allocation change has been growing less and less and less positive, which is sort of natural, given that equity proportions are increasing the size of the portfolios. And then all of a sudden you turn into a negative environment, where we've been throughout 2022, and we believe that will flip back up to be positive, i.e., we can already see from behavioral indicators that our people are adding back on. This is not flow data. This is other data that tracks how big municipalities, pension plans, etc., are allocated to equity market. I think it's quite interesting. Also, do remember that the equity market has already priced in a recession, i.e., we should go below 40 on the ISM before we can vindicate the fall that we've seen in the equity market. Now, we don't believe that we will go that low. We believe more in 94, 96 environment, that the equity market can shoot up now once the economy starts to slowing down. And then we can all sort of be in this game of, will we go in a soft landing or harder? What has been priced? What has not been priced? We believe that just looking at very simplistically on these kind of arithmetic kind of graphs, it's quite clear that we've already priced a fairly big downside, which we do not think will come. Now, earnings revisions have troughed. I think they will also climb go into 2023. Global GDP troughed, price targets troughed. So whenever you hear an argument that earnings will be bad, blah, 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 do remember that earnings revisions is what drives markets. And we're taking already a tremendous beating on this. And you actually can see a trough. And price target revisions have troughed as well, which sort of neatly, historically, coincides with coming troughs in the equity market. So a lot of the negative news, I would argue, are priced in. Now that the earnings revisions will continue to climb, I think is quite natural given the fact that economic surprise index are climbing on top side. So all these revisions, surprises, everything sort of is joined by the hip. So if you get beats in the economy, you're going to get beats on the earnings revisions. Um, and also, if you look at the national accounting profitability data, you can actually see a trough already in national accounting data, and we think that's going to spill over to the broader equity indices as well. Um, If you look at sort of holistic on a global view, why we're positive going to 2023, I think it's also important to remember the global credit impulse proxy as a percentage of GDP is actually now expanding. This is the first time since 2021 we have expanding global credit impulse indicator, and the last time we broke through it was end of 2019, 2020. And then you have the global Sentix index, which, as you all know, is a combination of sentiment and flows, and it's growing on the upside, i.e., people are allocating, as you can see in my flow data as well, to the equity market. I think that makes perfect sense. So we also think that hopefully 2023 will be the year when paradigms will change a bit more slowly. We have had a year, a violent year. We've gone through political risk to geopolitical risk to inflation, and then financial conditions, and then financial conditions collapsed, and then global macro, oh, sorry, U.S. macro took over, and then macro collapses, but financial conditions take over. This has been a quite volatile year in terms of these paradigms. We think 2023 will be a lot slower in that sense, which is quite positive. Soft landing, we're sticking to that because we're still admittedly in a soft landing. We can actually see that some indicators are making an effort to trough at least. If you look at US indicators, you can see yes, there's a downside, and we, as I mentioned, we see a soft landing, but others are maintaining a good clip in terms of growth. So we're not sort of, we can't go all in on a slowdown in that sense. We have to keep it a bit careful, both of us being priced, and also what kind of degree of slowdown do we actually see. We're still in soft landing, as I said. The recession risk, we really need to see this move sharply upwards for us to change this, but otherwise we still see a 25 percentage points recession risk. And most importantly, I think this graph is quite telling. We can anticipate where industrial production is going quite easily, and we can see it slowing down, soft landing, and you can see that you're becoming a bit more redder over here, i.e., a heightened recession risk, but you're not going into full on red. I.e., it's way too early to call this a recession outlook. It's a soft landing outlook, and also do remember that just around the time where we can see a recession data picking up a bit of a heightened percentage-wise, i.e., this 25% points for recession, as soon as they start to pick up that, the market is responding by putting in cuts from the Fed. So it's all joined by the hip quite neatly for this soft landing to actually materialize. So that's our outlook for 2023, and we'll see if it sticks. Global economic indicators rebounding maybe is certainly positive. This OECD indicator I have more trust in because I built a lot more on myself, and it's actually been rebounding a bit more since I printed this graph. So it will seem that we can actually looking at a comeback on the global economy next year as well, as soon as we get through the downside risks on Europe, etc., etc. Now, obviously, a more sophisticated business cycle measurement in the US is still positive. SAM rule, no indication of a recession so far. The indicators that are officially calling US recessions are still improving. So it's way early, I would think, to call for a recession in that sense. Now, the German recession that's about to happen, I think it's interesting to remember that we cannot really see it in data as of yet. If anything, the weekly short-term GDP indicators are rebounding. And I think this is a really interesting thing to keep in mind because if it happens that we have a German recession, yes, fine, it's already been priced. We can keep on. The equity market has to do its job to lead the GDP by 6 to 9 months. If you're going to have a recession in Q1, Q2, and then turn around late Q2, go into Q3, the equity market has to start to rebound right now, which is exactly what it's doing. But it's also quite interesting to think about what if we do not end up in recession. So that's quite interesting in terms of, for example, the euro dollar. Now, I can skip Italy, but another factor that we think is quite positive is the systematic stress indicators rolled over as well, which is quite telling for eurozone. And Sweden, a year ago, we went out and were super bearish Swedish real estate and Swedish equities. This time around, we are heavily invested in Swedish equities, and we actually called for a trough in Swedish real estate next year. We can actually see some little fishhooks now already starting to develop in terms of home prices. So this is a completely changed ball game, but do remember Sweden is a tale of two worlds, i.e. you have a retail stage which is the lowest ever recorded, i.e. lower than 1990s crash, and quite telling, manufacturing still in a sort of high gears in terms of strong growth. That means that we have to choose our equities carefully. Also to remember that it's not that difficult to front run Swedish equities with this black indicator that we made. We don't use it for we do use it for trading, but not in solely, because you can see sometimes it's actually some quite nasty gaps. But it's quite interesting now that you can see that for some time you see some pickup potential for Swedish equities, and now Swedish equities are responding. So we think we're going to stick to this. Quite interesting, and completely different outlook from a year ago. What could go wrong? The rate curves are obviously a concern to us, given the fact that it's signaling such a high proportion of recession risk. That said, not all rate curves are inverted. So the ones the Feds are putting more emphasis on, they are not inverted. We're not talking about money market yield curves. Uh, but it's also quite interesting if you look at the timing horizon on this one, because if we were to enter up in a recession, that's about the exact the same time where the Fed is going to cut rates according to the market, which obviously is not a coincidence. So we believe that there's a risk up there. We're monitoring it, but we can't have it as a main investment outlook. Um, Now, another thing that we've been working quite heavily with this year is FX. As you all know, that we're working with open FX risk exposure, and that means that we select the currencies that we invest in terms of equity investments. We do not hedge them. So for this year, this is inverted euro dollar on this axis, and this is a 40-60 portfolio. You can see how the dollar has been strengthening in tandem with the fall in this 40-60 portfolio. So i.e. the dollar has been almost a perfect hedge. Now, as of late, we have been shifting out of the dollar due to the rebound in the market. The reason why we're shifting out is that we've always been aware of the fact that we can use as the hedge. This is the euro dollar, and then you sort of see the rebound. But we always know that this is way off where it should be, given 3-year forward, 1-year rates on the UNIA versus OIS, or if you look at 10-year swap spreads, or if you look at net savings as a percentage of nominal GDP in the US. So therefore, we have been quite active in shifting into euros and even Swedish krona. The week ahead, we can, very quickly just have a look at, FOMC and hike 50 basis points, continued dovish language tilt. The year-on-year growth will drop by 0.5%, or the growth will drop by 25. So we won't be negative 0.5%, but the growth rate will drop or lose 0.5% in growth rate. Slight improvement in tertiary in the industry index in Japan, slight improvement in PMI in the US. We see 50 basis points hike in ECB. We don't see that much of details coming in QT. We see further deterioration in Swedish unemployment rate. Also on the radar, very very quickly, just for your just to be aware of that we're tracking trick. Look at the output gap. We do look at the debt ceiling going into next year, and also what kind of percentage do the US has to roll the debt on, etc., etc. What's going to happen going into next summer? We look at the obviously CBO forecasts, and also the fact that we believe that the budget balance will actually be again stabilized versus the debt held by public going into 2022 and also going into 2023. And that said, the GDP forecast you have on the left-hand side, the resulting medium risk asset allocation is in the middle, and your regional weights on the far right-hand side. And that was all for me. And this is just our track record, which we're quite open with, and in terms of how we performed this year, and our plans are trying to keep staying ahead of the indices going into next year. This is global equities, and as you can see in there, you have water purifying, you have Nordic ISG, you have Japan, European banks, European SRIs. It's quite a lot of Europe all of a sudden, which is I think quite interesting. And obviously, given our way of working with currencies, we're sort of still up in the money, so to speak, this year of using the dollar. But obviously, as of late, we've given up some of our relative performance given the fall off in the dollar. So that's why we shifted also the portfolio going to euro-nominated strategies, for example, also Swedish krona nominated strategies. Um, that said, I think that was the last page. We will be back in about a week's time. So I thank you so much for your attention, and I'll give you probably a brief update on the house view and outlook for 2023 next week. Thank you so much.